I have started the recording, guys. If you have any questions, like I said, you can stop me by raising your hand or just by typing in the chat. Okay. Now, as most of you know, I just use this for reference so you guys can have something to read, but I won't be going off this module 1 through to 4 exactly, right? So it's just going to be sort of like somewhat of a guideline, right? A lot of the examples that I'm going to be bringing in are going to be stuff that I just practically see and use and have used. So it's not exactly here, right? So don't get confused if you're not. I just try and simplify it as much as humanly possible and just take out a lot of the technical jargon that is involved, obviously, with trading. So I think we're looking at railroad tracks, right? Let's just go exactly to the pattern itself, right? Now, candlesticks form a very important and very crucial part of trading because, in a sense, they tell us what the market has done, right? Now, they don't exactly tell us what the market is going to do. I wish they were that efficient, but they do tell us and give us some vital pieces of information about what part of the market has done recently, okay? And in the past, right? Like 10 years back, 5 years back, 15 years back. So you get that sort of information. And now when you read that information, you need to be able to interpret it, right? It's sort of like someone who, let's say, braille, right? Let's say you have an sight impairment, right? You can't read, right? So you're actually blind. Let's just say blind, and in a sense, if you're blind, there's certain things that you can't actually make out, right? You can feel them, right? But you can't actually see them, so you can't really explain or talk about them as someone who does actually have sight, right? So candlesticks form the basis of what we're going to be doing on a day-to-day basis. Right? So a lot of people call that price action. Okay? Some people call it naked trading, naked charts trading. Right? The main objective is just to make money using this. Right? There is no other objective. It's just to make money consistently using this, no matter what you call it, no matter what nickname you give it. Okay? The killing machine or the pip hunter or the pip collector, it doesn't really matter as long as you're able to consistently draw profits using chart pattern. Okay, so a bullish railroad track is one of the patterns that we start with. I don't think we did too much about that or touched on too much on that. And the railroad track is representative of a price move that has actually gone down, gone up or down. Right? So let's just use the bearish railroad track. Now, if you remember from previous session, bearish simply means down. Okay, bearish is down. So these sort of chart patterns help us to see, or candlestick patterns help us to see potential reversals. Okay, so if the market has been rising, which means it's been on an uptrend, excuse me, it's been bullish, and we get somewhat of a chart pattern that looks something like this, right? Looks something like this. Then we sort of have this different way of thinking from there on. Now, as I usually say, this is not the only thing that you're going to be looking at, right? So confluence is important. You need to have a number of different things that actually point to that decision. Okay, so a lot of times we try and see what we want to see, right? Because markets are like that. A lot of people will look through the markets through their eyes, okay? And it's perfectly normal for people to do that. So the one thing that we use in order to become sort of like objective, and we're not particularly favoring what or looking at what we want to see, is we use confluence factors. Okay, so this will be one of them. Let me just say this. So if you can look at this candle, right, the market has been rising, right? So the white candles represent upward movement and the black candles represent downward movement, right? So you want to be buying Obviously, when the market is about to rise, if you want to be short when the market is about to drop. Okay. Now, we're not going to focus too much on where the entry is, or where do I buy, where do I sell, where do I put my stop loss and take profit. That's not of concern right now. The one thing that we need to know is how do I identify a pattern, right? Just give it a name and what it actually represents. What hint, what idea, what tip is it giving me? What is it telling me? So with this type of candle, you have a bullish candle, right? Usually a big candle, right? It's green, okay? Remember, white equals green here. And the green candle shows bullish pressure, right? It shows that there's a lot of traders buying that particular market at that time. So the market will rise up aggressively, right? Now in an uptrend, you're going to get a lot of these aggressive moves to the upside. Therefore, this will invite a lot of traders to actually go long, to buy, to start buying. Okay, but then all of a sudden you see a big red candle rather, which is the black one heading downwards. Right, now the two candles that usually characterize a bearish railroad track, right? So a bearish railroad track is complete when it has these two candles, one big candle going up and one big candle going down. Usually they don't have a lot of wick. They're not wicky candlesticks. They're not spiky candlesticks. By wicky, I mean this, right? These pins. Okay. Right. So these are wicks or pins. So they're not wicky. They don't have long pins or long wicks. That is something completely different. Okay. It's also a chart pattern that we actually look at, but that is not the one that we are talking about here. The one we're talking about here is a bearish railroad track. So you have two, as it's called, sometimes we call it Marubozu candles. Okay. So if you can go ahead and look up Marubozu, you'll see that it's a candle that usually looks like this. Okay. Then let me shade this one. Right, so there's the bullish candle, right? The candle going up, the green one, and the market closes, boom. And then there's a lot of selling pressure coming in, right? There's a lot of selling pressure coming in, and the green candle, okay, that actually closed, opens here, and then the market drops down and closes lower, right? Remember, if the market opened at, let's say, 13 Rand, so the United States dollar to the South African Rand is 13 Rand. If it opens here at 13 Rand and closes at 12 Rand, this candle is going to be red. Okay, so the market pushes down, boom, closes below where it actually opened. And in most cases, we want to see this candlestick a bit bigger than this previous one. Okay, so we want to see the down candle a bit bigger than the up candle. Now this gives us a hint in that the momentum could be shifting from upward to downward. So the momentum shift could be from upward to downward. So that gives us a hint or a signal. And then we take interest in that particular market after identifying that we have this candlestick pattern. Now the candlestick pattern itself, both of these candles forming this is what we call railroad tracks. Okay. Okay, guys with me. Now this usually occurs when the market is about to change direction. Okay, so from the buying pressure that pushed the market up, there's a lot of traders then coming in, applying the bearish sort of like pressure with the sell-off. So there's a lot of aggressive selling. Remember, if there's a lot of selling of a particular market, it will decline. Okay, it will depreciate, meaning it just goes down. And if there's a lot of buying, it will appreciate in value. Therefore, it will go up. It's sort of like a basic supply and demand type of thing. And as the momentum shifts to the downside, what you want to identify is where your entry is going to be alongside all these other confluences we're going to be using to make a trading decision. Okay, solely you can't just look at railroad tracks by themselves. They need to be at the right place of the market, along with other influencing factors that will give us a much higher probability of the trade actually working out, because that's all we're working with when it comes to trading, probability. Okay. Right, so that is what the railroad track would actually look like. Now, that is a bearish one, and this would be an example of a bullish one. Okay, the market drops aggressively to the downside, right? You can see that the market has been in a decline and drops down, and the bullish candle, which forms the bullish railroad track. Okay, bullish candle meaning up candle, the green candle. That bullish candle closes above this high of this previous candle, of the down candle. Okay, some people call that an engulfing pattern, right? I think it's a bullish engulfing. Some people call it that. But I mean, like I said, it doesn't really matter what you call it, right? As long as you know how to identify it and how to make it profitable for you, how to make money with it. Okay, that's the most important thing. So that is an example of a bullish railroad track, and likewise, it's going to work vice versa to a bearish railroad track, meaning you want to be a buyer at the right time once a bullish railroad track pattern occurs. Okay. Now, spinning tops. I mean, I think if you're familiar with what a spinning top is, you probably know what we're talking about even before you actually see what this pattern actually is, right? But this type of pattern shows price on either side of the body of the candle. So let me do this. Let me give you just an illustration, which should make things much easier for you guys to see. All right, so let's say this is the body of the actual candle, right? I think I made it a bit too big. Okay. Boom, right. So this is what that candle would probably look like. Okay. If you're familiar with what a spinning top is, okay, you have a body, right? And the wicks on either side of the candle will be more or less the same. Okay. So we're not talking a candle where the body is, let's say, 20 pips, and on one side the pin is like 90 pips, and on the other side the pin is 10 pips. Because at the end of the day, that looks something a bit more like a pin bar. Okay. Now the pin bar, as I've already stated, that is to me my favorite one, because it's just much more easier to spot. A pin bar is much more easier to spot and identify. And even if you just look at a pin bar as your only source of confirmation for a trading idea, then you will be okay. All right. I'm not saying don't learn these, because it's important for you to know them. But once you understand how the pin bar actually works, then you're good when it comes to pattern trading. Right, so that is how it would look typically, okay, without this long wick, right? And we will see its close cousin now, or what I like to call it is close cousin, the Doji Candle. Okay, now the spinning top can also happen as a reversal. Okay, now the market, let's say, has been moving up aggressively, and all of a sudden it stops, and then so let's say the market has been rising aggressively, and all of a sudden, boom, the market just hangs there for a while. And then we have a bit of a wick on the upside and a bit of a wick on the downside. Now, this is significant of what's going on, right? Because the charts, right? When you're looking at charts, you're looking at basically what traders have been doing, right? I'm not sure if I'm making sense. What you're looking at is all these different beliefs about whichever market you're actually trading. So if you're looking at the euro dollar, right, there are actual people or machines in some instances behind every single trade or order that actually goes through the market. Okay. So what is it about those particular traders that makes them want to buy at that point, that makes them want to sell at that point? Okay. Now, not everyone trades with candlestick patterns, right? But a large majority of retail traders will actually use candlestick patterns to make trading decisions. So that's why it's very important, even if you use them in the opposite sense, right? It's very important for you to understand the value of what a candlestick tells you and how this sort of jamming up, right? I can call it jamming up or just stillness within the market, where the market just basically does nothing for an hour or two. And then all of a sudden you see an aggressive move to the downside, boom, and then you wonder, all right, but this market was actually going up. I was making money on the upside. I was making money buying. And then all of a sudden the market just shifted direction, but you actually had a clue or a hint that there could be a potential reversal coming in with this particular candlestick pattern, the spinning. Okay. So it's very simple, basic to spot that one as well. Okay. Similar to the Doji. The Doji is a bit more. The Doji is like this. Let me explain it and also show it to you guys visually. Right? I like to make visual examples. Okay, so the Doji will be something along these lines, right? So let's say the current price of the United States dollar and South African rand is 13 rand. Excuse me, guys. So the market opens at 13 rand. Let's say this candle is 1 hour. I mean 1 day rather. Okay, so this candle here is 1 day, which means it actually took 1 full day for this candle to develop. Okay. So it took 24 hours for this candlestick to develop. And now this price here, this is where the market opens. So on Monday, when the market opens, it opens at 13 rand, the United States dollar and the South African rand. And then let's say around midday, it pops up to around 13.50 and pops down to 12.50. Okay. But by the end of the day, the market is back at 13 rand. Okay. So that is simply what goes on with each and every single candlestick. Okay. We did go through that already, so I won't touch on too much. On that. But what you have to understand is that when you're looking at these patterns, okay, when you're looking at these candlestick patterns, you always have to play around with these types of scenarios in your head. That okay, this is what's happening, so this must be what is happening with other traders. So when I say traders, I mean like commercial, your big banks, your institutional players, and everyone. Okay. With time, it's going to be much easier to sort of like conceptualize how things are, right? And to bring up ideas about, okay, here's what I can see, right? And this is what I think, or how I think that the market is being influenced to go up or being influenced to go down. Okay, so that is what a Doji candle actually looks like. And what it represents is a stillness in price, almost equilibrium, like there's a exact amount of buyers for an exact amount of sellers. So there's 10,000 buyers and there's 10,000 sellers. Okay, so the price just stays the same, stays stagnant. Okay, it might move up and down a bit, but relatively it is evenly matched. So if we have in a market that has been in an incline, all right, the market has been appreciating, it has been going up, you have been buying, you have been making money on the buy side, and all of a sudden you get, boom, this type of candle, which looks like a cross. I mean, that should tell you something that, okay, there's some sellers coming in, some aggressive selling coming in at this area, as well as there's a possibility that a lot of the buyers that were buying up the market at this point, the market while it was going up, are actually exiting their buy positions, because what you need to remember is when you buy here, right? When you open an order, you go to a platform, you place a new order. What you're doing, you're actually buying something. When you click buy, you're actually buying something, right? Although you don't get physical possession of it, you buy $1,000 or you buy 10,000 US dollars. In order for you to make a profit, like I said with the laptop example, I buy a laptop for 1,000 Rand. In order for me to make a profit, I don't care what the value of the laptop is. Okay, the value of the laptop could be 20,000, the laptop value could be 13,000 Rand, and I bought it for 1,000 Rand. But if I haven't cashed out, which means I haven't closed my trade, I haven't made any money, right? So, as consistent with the laptop idea, you're buying South African Rand, and all of a sudden, price pushes up, it's been going up, right? So let's say you buy that laptop for 1,000 Rand, and then tomorrow it's 2,000, the next day it's 5,000, the day after that it's 10,000, okay? Sort of like how Bitcoin was. And it just keeps going up, and then all of a sudden you get this bang, it's like it hit a wall. And then there's an equal amount of buyers and sellers on either side. The price might fluctuate up and down a bit, but it won't create a big range like you would in a, let's say, what's the other pattern we just did? Spinning top, for example, or a pin bar. Okay, so it's going to be in a nice tight range. So that is how the Doji candle looks like. And then if it forms at the end of what you believe is a trend or upward movement, then that could be a signal to go short, to actually sell. Right? It's not confirmation, it's just a signal. So, right, here's something, right? Bring your attention over here. That is typically what a candlestick pattern will actually do for you for now. Right? In time, once you're familiar with how to actually make, right, this is the example that I just showed you guys. Okay. So it's more or less the same as what a spinning top basically is. And if it forms at the top of the trend, okay, this is a very terrible example, but if it forms at the top of the trend, what it can signal is a reversal or a change in direction or change in trend. So that could warrant a short or a change in direction of bias from you, right? To get out of your buy order and then go into a short, or just to get out of your buy order. Right. So that is what a Doji candle will look like. Now indicators, right? So we spoke about indicators and what they can do for your trading. So a lot of people have been asking me about this indicator, that indicator, this one generates signals and all that stuff. I mean, some of them are just pretty, right? But you do find a few that can actually help you make better decisions. Okay. So those indicators will give us an idea of what the market will do. Right. So let's say you're driving, for example, right? And the driver in front of you indicates to you that they're going to be turning right. Okay. That is exactly the same thing that you would expect the market to do. Right? So the market is like that. It indicates to you that you could be turning right. Now, as with trading, there is no 100% certainty that it is going to actually turn there. Right? There's a high probability if you do your work properly, you do your homework properly, but you can't control the other driver. You can't control him and force him to turn right. Even though he indicated that he's going to turn right, but if he doesn't want to turn right, he needs to head straight now. I mean, that's something that's out of your control. So indicators are tools that we use to visually help us to see the market better. Okay. Now, a lot of them just cause clutter, and personally, I don't use them. But there's a select few that if you use them properly and effectively, you'll be able to make some money with it. So we'll be going through all of these indicators in due time, okay? All of these nice tools that we have on MT4 that help us to make better trading decisions. Those are the things that we are going to get posted up on our charts. We're going to get a nice template of all of those. And then with time, you'll be able to trade a few of those indicators. Okay? It's not going to be a lot, but you'll be able to trade just with the charts themselves. Okay. Now, the moving averages, as I mentioned about the moving average previously, EMA, exponential moving average, and simple moving average. Right now, the exponential moving average, sort of like how the simple moving average works. It just takes the average of the past couple of candles, depending on which time horizon you picked. So if you picked 21, it's going to take the past 21 candlesticks and it's going to plot a chart. Okay, it's going to plot a chart that follows the actual price itself. Right. So it's going to take the average price and it's going to plot a line right through the charts itself. Now this is really good in terms of finding the trend, or just at a glance we'll be able to see which trend direction the market is heading in. Okay, is it up? Is it down? Right? All of that stuff you'll be able to get from the moving averages. Now, the one other key advantage of the moving averages is that they are widely used and commonly used amongst traders, right? Retail level, commercial, institutional level, whatever. They are very commonly used, and therefore, they, once used properly and effectively, they will become very reliable. Okay? Because at the end of the day, you're not trading alone. The price is not influenced by what you do, but by what the large big players or the big money actually does. So if the moving average shows you that most traders are buying at this particular point, right? Right. So most big players, the big money spenders, they are buying at that particular point. You want to be a buy against the smaller guys. Right? We'll touch into that about how we determine, or we sort of like get this idea where this is where the retail trading side is. Right? The retail trading side is just normal traders, you and I. Okay, the guy trading in his underwear, you know, sitting at home, watching, so playing games on the side. So that would be a retail trader. Even the guy trading, really making some decent profits from the market, you know, millions and millions. If you're not trading at a professional level, which means like managing money, so then you're still a retail trader. So the retail traders obviously form the smallest part of this big sort of like pyramid. Okay, you've got these big banks and all of these guys, you know, with shirts, nice shirts, you know, multiple screens, and a lot of guys like to set up with multiple screens, you know, nice music in the background so you can swing around and all of that. Obviously, for me, I don't feel that's necessary, but those guys also influence the price a lot. So if they're using moving averages in a way, you want to know how they're actually using them and how you can make that an advantage to you. Right, so the risk side, the risk management side of things. So now we've sort of like covered most of what you need to know at the basic level. So what's important is the risk, right? Because with every single trade that you actually place, you are putting a risk, or you are risking something, and you want to risk as minimally as possible when you're starting out, because that means you'll have much more money to play with. Because if you have $1,000 in your account today and you lose $1,000 today, right, that means you have 0% chance of making that money back tomorrow. But if you have $1,000 today and you lose $100 today, it means you have $900 to come back with to make back that $100. So the key principle of risk management is making sure that you can trade another day, right? Because you can never make profits if you blow in your account. The correct proportion in percentages of risk that is optimum is starting off with 1%, but you need to be able to make money consistently first, risking 1% for each and every single trade. I'll give you guys something to work that out. Right. Now, the second key principle that is crucially important when it comes to trading principles, basically, is the risk-reward side. Right. Now, risk-reward ratio, as it's termed, is simply how much money are you willing to put in and how much money are willing to take out the market. So I'm willing to risk 100 Rand to make 600 Rand. I'm willing to risk 100 Rand to make 300 Rand. But that is one of the key advantages that we actually do have as traders, is that we can have a higher reward ratio, a higher reward for much smaller risk. Okay, so a positive risk reward ratio means that you can lose more trades than you actually win and still make money. Or you can win half your trades and still make money. And then when you're winning the majority of the trades and you have a good risk reward ratio, that is when you'll start gliding. That's when things will become smooth. Right? So minimum risk reward ratio that you're going to be starting with is 1:2. So if you're risking 20 pips, you need to be able to make 40 pips on that particular trade, right? So it needs to stay consistent. Okay, so just spoke about this already. Now, drawdown. Right? Drawdown just refers to a decline in investment, or let's say the trading account. So if you have $1,000 trading account and you lose $100, okay, that means your account peak to valley, right, from high to low, has a drawdown of 10%. Okay, now it also works with equity. Or sometimes you have $1,000 in your trading account, right, and you are currently losing $100. That means you haven't taken the money hasn't been taken out your account. Okay, the trade is still open. But now, since you are currently in drawdown, which means that $100 it's going to be minus, right? On your platform, you're going to see minus $100, minus 99. That trade is still open. It can still turn around for you and go in your direction. Okay, but the 10% is the total drawdown that you actually have on your account. Now you want to keep drawdown to a minimum, right? And obviously the winning side, the winning percentages on the up and up. Okay. Now I won't talk too much about losing streaks because there is a PDF about this, okay? And I already did touch on it a bit. And I think the very last part of things, the very last part that I hopefully will have time to cover tonight is the lot sizing, right? The lot sizing is how many units you want to buy yourself. Right? So what I'll be doing, guys, in our next session, okay, I'm not sure if we'll be able to finish up because I think we have about 2 minutes or 1 minute left. So if we can't finish up now, okay, I will be doing this again in the next session because I also feel like a lot of the more advanced guys actually do still need this. And I will have, I think I did send through the Excel spreadsheet. I think the Excel spreadsheet is on the group, right, the Telegram channel. Just go back, you'll be able to see an Excel spreadsheet written forecast. Okay, it's written forecast and it has all of this information about what lot size to use if your stop loss is this big, and if your trading account is this big. It will help you to get rid of the calculation side of things, although you need to learn how to do that yourself firstly before sort of like dedicate that to the Excel spreadsheet.